Welcome, everyone, to the June 2026 edition of Clear Vista Financial Perspectives. I'm Mark Trice, and I really do appreciate you taking time to join me today for our monthly market update webinar. A lot of changes in the month of May, um, so we're going to dive into that. And my hope is that what I have to say will at least help put your mind at ease. We'll walk through all of that, what this means for you, your investments, and your peace of mind. All right, let's jump in. Today, we're going to cover the market recap. Had a great month in the market in May. I'll go into some updates in the economy, some changes with the Federal Reserve. We'll talk about how the economy is growing, and we'll also update a few stats that we normally do in our presentations. So let's jump in to the market recap. Let me start by saying you can always send us questions to info@clearvistafinancial.com or on our text line at 254-282-0495. And we'll try to answer those during the program, but oftentimes we get busy and have a lot of slides to go through and data to present. But we will definitely reply to those questions or inquiries via text or the email within 24 hours. So let's take a look and see how the market did this last month. So, in spite of still higher interest rates and headwinds in the bond market, the stock market continues to reach all-time highs. In May, the S&P 500 surpassed 7,500, and there have been 22 all-time highs this year through the end of May. So, the fact that major indices like these reach all-time highs is not unusual during a bull market. And because historically markets have trended upward. Yes, there are some times where there are drawbacks and drawdowns and things, some of them quite significant. We call those bear markets. But generally, the long-term trend for as long as I can remember has been an upward trend. So let's talk about the indices. The S&P 500 was up 5.1%. In the month of May. The NASDAQ was the top performer, led by a lot of artificial intelligence related companies. The NASDAQ was up 8.4% in the month of May. Russell 2000, which typically deals with smaller or small cap companies, those with revenues below, I think it's $1 billion. But that index was up 4.29%. The long-term treasuries, it actually had a kind of a roller coaster ride this month, starting out at a certain level and having yields rise rather rapidly throughout the month, only to finish basically flat for the month of May. And then our moderate index, which is where a lot of folks have their portfolios, is plus 1.96 for the month of May. As always, we want to give disclosures, and I'll kind of talk about the markets a little bit. It's good that we're continuing to see these new highs set, even with the Iranian conflict going on. There doesn't seem to be an end in sight, even though the White House may be telling us there's an end in sight. And so I think overall in the month of May was a strong month. It showed a lot of strengths in many different sectors. And so that's a good thing. Let's see where we are in the volatility cycle of the S&P 500. Usually the month of May, we're still kind of in this declining volatility, which I think the other day I looked at the VIX or the volatility index, and it was down below 16, which is very positive. And hopefully we'll have low volatility this month. But a lot of that's going to depend on geopolitical events around the globe and what else is happening in the economy. We're getting into the earnings season or wrapping up the earnings season for the second quarter. And so, we're seeing those things, and we'll have to watch that volatility as well. We have a new Federal Reserve president, chairman at least, Kevin Warsh. And there's a lot of debate over what will happen with him. It so happens that the former Fed chair, Jerome Powell, is staying as a board president, which really hasn't been done a lot since the Fed was created in the early 1900s. And What's happening with the Fed is that they're still seeing that inflation is a problem. A lot of that has to do with rising oil prices because of the Iranian war. And we'll see that, those disruptions to continue to take place until that conflict is over. So right now, the markets, and I say markets, these are really the interest rate hawks and the inflation hawks. They're looking, and there's a 50-50 chance that we may actually have an increase in interest rates before the end of the year. It all depends on what's happening. So a lot of people were thinking that with Kevin Warsh in the leadership seat, that there will be interest rate cuts very quickly. I don't think that's going to happen. I think there's too much potential data that's out there that says that now is not the time to cut. He may be under political pressure to do that, but the Fed tries to be independent on these things. So, Fed decisions affect borrowing cost, housing, inflation, and asset prices. So we will continue to watch that. They do meet in June, and then they'll take a break and meet at the end of July or early August for that. So we'll watch that. So it's anticipated that Kevin Warsh is now, he's a business person and he's got a lot of experience with the Fed. We hope that has some positive changes, but it's really, will the Fed ever truly be independent? I don't think so. So we'll just have to watch how those leadership changes change the conversation within the Fed about inflation and interest rates and things. Okay. So, economic update. Remember, you can send your questions to our text line 254 282 0495 or email us at info@clearvistafinancial.com. Of course, we'll try to answer those on the program, if not within 24 hours. So, let's talk a little bit about the current economic environment. This is the yield curve. Right now, you kind of see the yield curve ranging from a low for short-term treasuries of 3.4% or so, all the way up to just a hair below 5% for the 30-year rates. Now let's dive in this a little bit closer. One of the most important developments in May was really the volatility around interest rates. I told you that the bond market was very volatile during the month. It dipped, long-term treasuries fell in value because rates were rising, only to end up the month just slightly where they started the month. And this occurred for a number of different reasons. Number one, we'll get into it in a second, the consumer price index. The consumer price index was higher than expected. And so we had stronger inflation than expected. A large part of that was the higher oil prices, but we're also seeing that begin to deviate just a little bit. I know when they were high, the price of a gallon of gasoline was 4.20 maybe in Texas, in Central Texas. Now it's around 3.65 or 3.59, I think I saw this morning. I'll find out this afternoon because I've got to fill up my tank, and hopefully it's less than $100 or because I have a big tank. So this is a chart here of historical interest rates over time going way back to the 60s. And you can see there in the 80s, we had high levels of interest because of high inflation. The yellow line is the 2-year Treasury yield, and then the blue line is the 10-year Treasury yield, which a lot of the products like credit cards, car loans, mortgages are pegged somewhat to the 10-year yield. And as we just discussed in an earlier chart, we were seeing the 30-year note close to 5%, and then the 10-year note was around 4.4 or 4.5%. That impacts the cost of borrowing, and it has its ripple effect through the economy. I'll show you in just a moment some of those other ripple effects. But the silver lining here is that higher yields are creating more attractive income opportunities in bonds than we've really seen in years. Because remember, we had this period from 2020 where interest rates are falling and yields were falling. And so that is a positive thing for those invested in bonds, trying to attract those higher yields. Let's look at the GDP. Gross domestic product grew in the first quarter at an annualized rate of 1.6%. That's well below the expectations, and that's in somewhat because of the Iranian conflict. Consumer spending was a little bit weaker, and inventories were reduced, but still, business spending by consumers, business investments, and housing grew. Those are positive things. And then the inflation side of this was a little bit lower, and we revised previous GP numbers to about a 3.5 annualized rate of growth. I think one of the interesting things that we're seeing, I hat trick to David Bahnsen, tip of the hat to David Bahnsen for reporting on some pre studies by Harvard and a couple other economic institutions. And one of the Harvard report was saying that in 2025, that almost 90 or a little bit over 90% of all the economic growth in the economy came from construction of data centers. Now, I know data centers are a hot topic. There are signs around that say no data centers and all that stuff. Regardless of your opinion of those things, in 2025, they were a large driver of the economy. And I think they continue to be a large driver of the economy. What this means is that if data center construction is a large driver of economic growth last year and maybe into this year, that other sectors are actually rather weak or less strong in in the situation that we're seeing. So we're going to watch that. We'll see how much that has an impact in 2026. Um, but inflation is still elevated, and energy prices did go up. So I don't see that we're going to see any cuts in the Federal Reserve overnight Fed funds rates. But a lot of different things can stabilize or destabilize that, and a lot of that happens to be what's happening around the world with different conflicts, and especially the Strait of Hormuz. So the producer price index, this is a kind of another proxy for the consumer price index. I don't think we have a slide on the consumer price index this year or this month. But producer prices rose 1.4% in April. It was expected or forecasted to be about a 0.5%, 0.5%. And that's up 6% year over year. Energy drove a lot of that increase, but food prices also increased 0.2% as well. And so I think in this next meeting for the Fed, even though it is the new chairman, Warsh's first meeting, I don't think that they're likely to cut interest rates at this time because of that stubborn inflation. Okay, employment in April, we still don't have the May reports out, but we'll talk about April. 115,000 jobs were added to the economy. That was well above expectations of $65,000 or $65,000, 65,000 new employees. The unemployment rate remained at 4.3%. And the hiring leaders, what sectors were hiring the most were healthcare, transportation, and retail. Weak areas, manufacturing, and government. And then we knew government was going to be falling with the Trump administration. So the labor market remains strong right now. We never look at 1 month of data and say that it's going in a certain direction. We have to see a trend. And right now we're remaining stable, if not ticking up just a little bit. All right, new home sales. This is important. It's down in April. The annual rate was about 622,000 new homes sold. That's down 6.2% from March and down 11.3% year over year. And I think the largest part of this is like higher interest rates. The positive news from all this is that builders have responded by offering incentives and lowering effective prices through those incentives. But the inventory of new homes is at its highest level since 2009. And that's great for buyers. Yes, interest rates are a little higher than they were 2 years ago or 3 years ago, but that gives buyers more choices with more incentives with new home sales. Existing home inventory, it's still a tight market. And that's mainly because a lot of homeowners are reluctant to give up those low interest rates in the twos and low threes. And so that could, if interest rates start dropping again, I think you'll see the housing market pick up quite a bit. And this is also reflected in the housing start data. That's down a little bit from March, but it still is improved year over year over previous years. And single family homes starts were down 2.4% year over year, but multifamily starts, apartments and things like that, were up almost 20% year over year. And those starts rose in the Northeast, the Midwest, and the West, but they fell in the South. So we'll just have to continue to watch that. Housing supply is improving, but higher rates and weak builder confidence continue to limit new single family home activity. Okay. Let's talk about durable goods because this was a positive number in April, that plus 7.9% in April. That's over 17.2% year over year. And this is one of the bright spots in the economy. And importantly, the strength wasn't limited to aircraft orders, which was a large part of this, but it was broad and across the board. This could be because of AI spending and a favorable business environment, but growing backlogs suggest demand remains strong and factories are working to keep up. So those are all good things. Business spending and manufacturing activity remain resilient. Month of April. Let's talk about the overall economy. I think the headlines often sound negative, but the underlying economic data is relatively solid. You know, we saw the GDP tick up 1.6%. Analysts and economists predict that that could be, this is coming from GDP Now, the Atlanta Fed tracks this. They're tracking that as of the other day around 3% for the second quarter. So the economy is improving. And with jobless claims remaining at historic lows, these are all positive things. But the inflation is elevated, and this keeps the Fed cautious on rate cuts. And in fact, there's a 50% chance that they might even raise rates this year. So AI and technology continue to drive investments, but we don't see any reason to say that that a recession is imminent or even near. But the economy may not be booming, but it does continue to show some resilience with that. So what's all this impact for you? What does this mean? Let's just have a quick discussion about what you should do. First of all, you need to talk to your advisor. If you have not checked in with your advisor in 12 months, you probably need to have a check-in. If you don't have a financial advisor, we'll be glad to give you a chat and just talk about your situation, maybe give you some pointers. But most important, don't panic on the news. Avoid the headlines. Avoid decisions driven by those headlines or artificial intelligence. Artificial intelligence still hallucinates. They give you the wrong answers, not intentionally, but then again, artificial intelligence does not have a conscience, so they can readily give you the wrong advice. And especially, and I see this often, and I just smile when my clients talk about it, each of us has our own biases, whether that be political, but most of us have political biases, and don't let your decisions be driven by that. Take a step back. You have your worldview. Look at the other side of the aisle and try not to make decisions based on the headlines there with that. Just stay informed. That's the most important thing that you can do. So if you're worried about your retirement, you can give our team a call for a free consultation. You need to understand your options. There are so many options out there for folks that are invested in 401ks or workplace retirement plans that you don't even know about. And we'd be glad to share that with you. All you have to do is tell us who you work for and who the plan provider is, and we'll be glad to help you do that. You have lots of different options, and we have lots of different tools available to help people make investment decisions, what's right for them in their workplace retirement plans. Okay? So as usual, we're going to go over a few things. You always want to check your statements. They should be looking good, but you want to check them and make sure they're keeping up keeping pace with what's going on in the market based on your risk profile and objectives. You always want to talk to a professional and, more importantly, educate yourself. But don't educate yourself with TikTok videos, because we find a lot of those influencers out there are giving bad information for clickbait. And so we encourage you to take action on your financial journey. We're always here to help you, whether it's a recession, a bull market, a bear market, or anything in between. Let us know if we can help. The first step is just asking for help. And we'll share our contact info here at the end of the presentation today. But if you don't have an advisor and you haven't talked to them in the last year, you really want to talk to somebody. And I encourage you to call your current advisor. If you don't have one, please give us a call. So we're looking at questions here. I don't see any on the board, but no, you can send us questions anytime. We're not just around the webinar, but you can contact us at the numbers on there. You can send us an email at info@clearvistafinancial.com. And then you can always text us, and that's sometimes the easiest way to get a hold of us, at 254-282-0495. That's 254-282-0495. And if you're new to us, we always offer complimentary consultations. We'll look at your portfolio. We will talk to you about your situation, make some suggestions. And if we can help you, we'll tell you what that relationship might look like and how it will work. Until next time, folks, we'll visit with you on July 2nd, right before the July 4th holiday and the 250th anniversary of our nation's birth and founding. I know we're excited about that to watch around here, and I hope you are as well. Thank you for listening today. You've been listening to Clear Vista Financial Perspectives. Have a great month.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.